Welcome to the deep dive. So our mission today is to give you a shortcut to understanding what I think is the market's biggest paradox right now.
hmm
You've got this overwhelming momentum, that continues to favor these big visible tech sectors, but it's running directly into some acute, persistent operational risks.
Execution risks. And that tension, it really defines the current environment. I mean, you look at the broad market tone, and it is, for the most part, constructive.
Right.
Large caps are leading the charge, continuing this, powerful momentum trade we've seen all year, especially in anything tied to AI.
But not everything is rising.
Exactly. And that's
Yeah.
crucial. We see the market getting picky. Small caps, certain global indices like Japan, they're softer. It shows that not all boats are rising equally.
Okay, so let's nail down that market snapshot. We're seeing the S&P 500 up,
Yeah.
what is it, over 0.4%. NASDAQ pushing higher, almost 0.7.
Yeah.
And here's a critical detail I saw about the flow. Crude oil and gold are both firmer, up about 0.5% each.
And that's so important. Normally, if investors were genuinely terrified of the downturn, you'd expect stocks to drop and that classic fear hedge, gold, to spike aggressively.
But that's not what's happening.
Precisely. The fact that stocks, oil, and gold are all firm at the same time, it tells us this is not fear-driven hedging. It's much more consistent with a healthy risk appetite. Money's moving around, but confidence is still pretty high.
Investors they seem happy to pay up for premium assets with that predictable growth.
They are. But that brings us right back to our core tension. You pay that premium for visibility, for the promise of AI growth or massive scale.
And then almost every day you get a new headline, an outage, a regulatory snag, a deal that suddenly looks way too complex.
Right. It just confirms that the underlying operational friction, it hasn't gone away.
It's the difference between the idea and the reality.
Exactly. You price a company based on its scale advantage, but then you canalize it based on its execution failures. And our mission today is to show you where the market is drawing that very fine line, where selectivity still matters more than anything.
Okay, let's start with maybe the clearest signal of urgency we've seen lately. And it comes straight out of the AI race. We heard about OpenAI's internal code red around its competition, specifically ChatGPT. I mean, that sounds like genuine panic, like the whole AI story is starting to crack.
It's a really compelling headline, but I think we have to look past the theatrics a bit.
Yeah.
Historically, these internal code red alerts, I mean, we've seen them at Google with Gemini, and even decades ago at Intel and Microsoft.
So this isn't new.
Not at all. And they are rarely about a genuine technological failure. They're almost always a mechanism used by management to force a radical, immediate shift in corporate priorities.
So it's not the fire alarm. It's more like an immediate reorganization order. It sounds like a necessary, if dramatic, management tool.
That's a great way to put it. It serves two functions. Internally, it mandates the immediate reallocation of your best engineers away from long-term research and toward, product delivery.
Puts everyone on a deadline.
A hard deadline. And externally, it's management reassuring investors that they fully get the competitive threat and are responding aggressively. They're showing they're willing to burn the boats, so to speak, to stay ahead.
And that's where you see that shift, right? From just research to actual product delivery. That's where things get really interesting for investors. The focus moves from who has the best white paper to who can actually ship a usable, reliable product first.
And the insight for you, the learner, is so critical here. The signal is not that the AI narrative is failing, it's that the market is realizing the race is now moving into, let's call it, phase 2.
And phase 2 is decided by?
Execution speed, reliability metrics, and maybe most importantly, distribution.
Distribution is the key word there. How does an investor actually measure that beyond just reading press releases?
Well, you have to look at tangible metrics. Are they locking in massive multi-year enterprise contracts? What's the quality and stability of their API usage? Are developers abandoning them because of latency or cost?
I see.
And are they building those essential partnerships with the major cloud providers that allow for immediate deployment? Rhetoric is cheap. Reliable uptime and integration into key business workflows, that's expensive, and it's really difficult to execute. That's the true sign of winning.
Precision over prophecy.
Yeah.
Got it. Okay, let's pivot from execution in AI development to the execution risks that are just inherent in capital allocation. I'm talking about M&A.
That takes us directly to the hypothetical Netflix agreement to acquire Warner Bros. Discovery's studio and streaming assets. A potential multi-billion-dollar deal that would, fundamentally redraw the media landscape.
Yeah.
And the market reaction was a perfect case study in execution skepticism.
It was counterintuitive, wasn't it? WBD, the seller, rallied sharply, while Netflix, the ambitious buyer, saw its stock actually decline. Why would you punish the leader for taking a massive step toward market dominance?
Because the market rewarded WBD for crystallizing value, for simplifying its balance sheet. It punished Netflix for accepting a massive risk premium.
And that risk is multi-layered.
Oh, absolutely. You have integration risk, which is just the sheer complexity of merging two fundamentally different corporate cultures. And then you have the regulatory risk. The market is signaling deep, deep concern about taking on that much leverage and operational complexity, even if the strategic logic seems sound.
Okay, let's dissect that logic. The pro side is huge. I mean, Netflix would instantly lock in this massive, diverse library of premium first-party IP. It could create bundles no one else could touch, forcing consumers back to, one or two heavyweight platforms.
But the cons are equally titanic.
Yeah.
You mentioned regulatory scrutiny. This isn't just a basic antitrust review. This would be viewed as massive content concentration.
And regulators would look at that very closely.
Very closely. Particularly in the US and Europe, they'd look at precedents from past cable or telecom mergers, and they would ask if this deal ultimately harms consumer choice or innovation.
Is the regulatory environment right now, is it friendly to deals of this scale?
Absolutely not. The current political and legal mood is, I would say, very skeptical of mega mergers, particularly in areas that affect information and media distribution.
Right.
And the fact that there's a sizable breakup fee, which the sources indicate is substantial, that shows the parties themselves acknowledge there's a significant chance regulators could just block the deal entirely.
So that fee is basically the price the buyer pays just for the attempted execution.
It is. It's the cost of trying.
So if this deal were to go through, it accelerates the end of the fragmented streaming war and moves us into an era of just a few massive platforms. But for Netflix, the financial execution is still everything.
It is. Investors are immediately asking, what is the final price? And crucially, what's the funding mix? Is it mostly debt, which increases your leverage and costs? Or is it equity, which dilutes existing shareholders?
And how much flexibility do you have left over?
Exactly. How much financial flexibility is left after this huge commitment? Netflix needs capital for content, for technology, for AI integration. A perfect M&A execution means you complete the deal without handcuffing your future investments.
That's a smooth transition right there.
Mm-hmm.
From the execution of capital allocation, let's move to operational execution and the hidden costs that come with reaching, maximum scale.
Which reminds us that these centralized systems are often really fragile.
And we saw the perfect illustration of that fragility with Cloudflare.
We did.
They suffered another outage that, for a short time, disrupted traffic for an estimated fifth of the entire web. This wasn't just a minor blip.
No, it impacted major platforms globally. And it happened only weeks after a prior failure that management had publicly called
Unacceptable. I remember that.
unacceptable. And this is the curse of being the internet's plumbing. Companies that benefit from these powerful network effects, where everyone uses them because everyone else uses them, they achieve incredible scale. But when they fail,
The damage scales just as quickly.
exactly, repeated outages, they fundamentally change the risk calculation for investors. It moves the whole conversation away from growth story and toward systemic risk.
So if they were essential internet infrastructure, reliability metrics have to be just as important as their revenue growth.
They absolutely are. We should probably view them less like a growth tech company and more like a utility.
Okay.
I mean, if your regional power utility has 3 major grid failures in a month, you don't reward them for adding customers. You demand regulatory intervention. For critical infrastructure, failure instantly translates into massive reputational damage and increased scrutiny, and that could lead to regulators imposing really costly reliability mandates.
Which is an execution failure with compounding costs.
That's it. And speaking of costly regulatory compliance, let's look at Amazon in Italy. This just shows that regulatory drag is a constant, expensive cost of having global scale.
What happened there?
So Amazon's Italian logistics unit settled allegations related to tax and labor practices for roughly 180 million euros. And this involved discontinuing a pretty contentious monitoring system for delivery workers
Okay.
and resolving issues related to how value-added tax or VAT and Social Security were handled through their intermediaries.
So the settlement wasn't just about the money. It forced actual changes to their operational processes, like that worker monitoring system.
Exactly. When you operate across dozens of jurisdictions, you are constantly being pushed to standardize and perfect compliance across, vastly different regulatory frameworks. This case is a perfect example of regulatory cleanup being an ongoing cost of scale.
It's just part of doing business at that level.
It is. These settlements, they close legacy risk overhangs, but they remind investors that large platforms have to budget substantial capital and time simply to stay legally compliant everywhere they operate. And that friction, it slows down innovation and development.
Right. We've spent a good amount of time decoding where all these execution risks are hiding. Let's finish by pivoting to some of the positive fundamentals, looking at sectors outside of big tech's constant crisis management, just to get a balanced view.
Yeah, that's a good idea. We saw a really strong signal coming from the Canadian financial sector.
The big six Canadian banks, they reported an exceptionally strong quarter, right?
They did. Earnings growth was significantly ahead of expectations, and it was helped primarily by surging fee income, not just interest margins.
And 5 of the 6 raised their dividends.
Which is a huge sign of health and management confidence. The story remains solid, provides great stability and yield. However, context is key here for an income-oriented investor.
What's the context?
These strong results have pushed the sector valuations to about 20 to 25% above their long-run averages.
And why is that 20 to 25% increase particularly important for a bank stock?
Well, banks are typically valued for their stability, for their yield, and for a lack of massive volatility. They don't usually trade at huge growth multiples.
Right.
So when a stable sector is trading 25% above its historical average, it tells you the market has fully priced in the good news and that stability premium. The easy value trade buying low when the market was nervous, that's played out.
So for the long-term income-focused investor, this is now a hold. You hold for the yield and stability, but it's not a fresh, deep value opportunity for capital appreciation.
Precisely. The market has fully digested that story. On a different note, we also saw a surprising signal of consumer resilience from the retail sector.
Macy's raised its guidance. In a cautious macro environment, that definitely feels counterintuitive. What were the specific details in their report that made that possible?
It wasn't just, generic optimism. The guidance raise was attributed to effective inventory management. They avoided the costly overstocking we saw in prior quarters and stronger than expected performance in their digital channels. And also in certain luxury merchandise categories. It suggests that while the consumer is being selective, they are willing to spend when they find value or quality.
That's a good data point.
Yeah.
What are the key items we need to be tracking this week to see if this consumer resilience is broad or if it's just isolated?
So we're immediately tracking the upcoming broader retail sales data and general card spend reports to confirm that Macy's experience wasn't just a one-off.
Okay.
Beyond consumer spending, the market's monitoring high-level leadership shifts, particularly the recent senior departures at Apple in areas like sustainability and legal.
And what do those signal?
They can signal internal decision-making changes that could affect future product or regulatory strategy. And critically, investors will be watching very closely to see if major U.S. banks report the same kind of fee income strength that we saw bolster their Canadian counterparts.
That gives us a very clear, forward-looking roadmap. So bring it all together. What's the single biggest lesson for the learner trying to navigate this current market?
I think the lesson is that visibility attracts capital, but it's flawless execution that determines who keeps it. The current market momentum is strong, no doubt, but the decisive factor in these high-stakes industries, whether it's integrating a massive, complex deal or standardizing global compliance or ensuring absolute reliability for essential internet infrastructure, it's operational perfection.
The tension is palpable. Investors are willing to pay these, historical premiums for the promise of scale, but they are demanding flawless operational execution in return. Any slip-up, whether it's a system outage or a regulatory settlement, is being immediately priced into the stock.
And that leads us back to the sheer cost of failure. We noted that the Cloudflare outage briefly disrupted traffic for an estimated 1/5 of the entire web.
Yeah.
So, given the increasing concentration of critical infrastructure in the hands of so few companies, if reliability metrics are now essential for valuing these providers, how should the potential systemic cost of their failure, the disruption to the economy as a whole, how should that affect how we assess the true long-term price of scale? What stands out to you as the greatest execution risk moving forward?
A question that demands a deep consideration of risk management. Thank you for joining us as we explored that fine line between market momentum and execution reality. We'll see you next time.